Joining us now is former chief investment strategist of Bridgewater Associates, senior fellow now at the Council on Foreign Relations, Rebecca Patterson. Rebecca, welcome.
Good to be here. Happy Friday.
Happy Friday. You see any evidence of inflation from tariffs?
I think most economists do. So I'm super excited to hear what Governor Myron has to say in more detail Monday when he speaks at the Economic Club of New York. I mean, just to give you one of many examples, if you look at appliances, last year, the first 7 months of the year, appliance prices were down 0.6%. First 7 months of this year, they're up 3.3%. That's tariffs. That's nothing but tariffs.
Okay. Now, in the old school, if you were concerned about inflation, you might buy gold. Ray Dalio, among the voices calling for gold to be 10% or so of a portfolio. You think that's called for?
I think 10% is an aggressive position, but I think it depends on your risk appetite and what else is in your portfolio. But look, I've been bullish on gold for about 2 years. I'm still bullish even at these levels. My original thesis was central bank reserve diversification. Central banks have bought 1,000 tons a year of gold for the last 3 years. That's about double the pace of the previous decade. Now, they're slowing down a little bit this year, but they're still buyers. And if you look at the World Gold Council survey, they're suggesting that almost half of the central banks they surveyed are expecting to add more in the coming year. But more recently, the bigger driver has been retail investors, institutional investors who say, I'm not as confident as I used to be that bonds are going to diversify my portfolios. So gold is a complementary diversifier. If you look at the last 39 falls in the S&P 500, 5% or more, the average fall of those periods was about 9%. And you look at what gold did in those instances, it was up on average and the majority of those instances. So it has proven itself to diversify. By the way, over those periods, 39 falls of the S&P of 5% or more, Bitcoin, diversifier, digital gold, down 5% on average, down 70% of the time. I'm just saying.
All right. You came armed with stats. I love it. Even as we're having this conversation about gold, we've seen the dollar continue to weaken here. And we've seen some interesting moves, including this ever steepening yield curve here. I want to get your thoughts on that as well.
Well, it's not surprising to me to see the 10-year yield higher after the Fed cut. Now, in the olden days, past decades, when inflation was much lower, when inflation came down and the Fed was cutting, it was cutting because the economy was slowing and the 10-year yield would come down. Today, though, inflation is running a lot hotter. I mean, core PCE is on track to be 2.9% again in August. And so we're about a point ahead. And we have an economy that's running pretty hot, despite the labor market slowing. The Atlanta Fed is telling us GDP is running well over 3% right now for the third quarter. So when the Fed is juicing the economy, so to speak, with already decent growth overall and with inflation running higher, it makes sense that the market's going to price in longer term, higher growth, higher inflation, so that yield goes up. It makes sense that that's happening today. We're in a very different world than the last 15 years or so.